Good afternoon. My name's Rohan Batra. I'm a financial advisor here at Hargreaves Lansdown, and along with my colleague Adam Kent today, we'll be discussing passing your wealth on. Over the next few minutes, we will be running through quite a lot of content. So just to give you a brief overview of the agenda, we'll be discussing your understanding of your relationship with money, how you've gone about making your own financial decisions, how to decide how much to pass on to your loved ones, the ways in which you can pass on your wealth, the tax implications, and the role that advice could play for you. Before we really get into it, though, just wanted to make you aware that today I hope you find that all the information is really helpful, but it is not personal financial advice. That said, if you would like advice, there are some contact details that we'll put up at the end of the presentation that you can that you're more than welcome to use to contact us. So if we begin then, so understanding your relationship with money. I think first and foremost, it's important that we point out that even though today's presentation is about passing your money on, your wealth is there for you to live comfortably during your lifetime. And that means that you should not give away any money that you may well require, and we'll go on to that later on in this presentation. So I often start by asking my clients to think about what their ideal lifestyle looks like to them. So if we take retirement, does one's retirement involve a lot of travel, maybe around the world cruise, whatever that may be? Or do you want to spend more time at home, spend some more time in the garden, or somewhere in between the two ends of that spectrum? Once you understand what your ideal lifestyle might be, you can have a better understanding of the amount of money that will cost you. Leading on from that, then, think about how you feel about holding on to your assets. Quite interestingly, some studies not too long ago said that many people formed their relationship with money by the age of 7. So reflect upon how you feel about money, how you feel about holding on to it, whether you view it as an asset to use to live comfortably, or if you're really driven to build your own wealth and you like seeing the month on month, the year on year increases. Once you've thought about that will help inform you as to how you would feel about giving up some control of those assets, how you would feel about passing that on to your family and potentially gifting it to them. But not only could you gift your family assets, you can also give them your own wisdom. So think about how you got into your current position. So what did you do successfully? What decisions did you make that paid off really well, that have helped put you in the successful position that you are in today? And are there any of those lessons that actually you think other people will benefit from? There are probably some hard lessons you've learned along the way, whether that's a poor investment decision, trusting someone that you perhaps shouldn't have done, or just riding out the rough that comes with the stock market sometimes. So think about the hard lessons that you've learned along the way, and again, what parts of those could you pass on to your loved ones? Thinking about what you should pass on, I generally look at three buckets, 3 categories here. First are those assets that you definitely will need: the roof over your head, the money that you use day to day. Those things are not assets you should be passing on. Those are things that you definitely will need, and you should keep a firm hold over. Next, look at assets that you might need. A prime example of this are the assets that you may need to fund you if you were to need care in the future. Certainly, that's no guarantee, but it's definitely an area that needs to be considered quite carefully. And you need to strongly consider whether or not you should be giving up assets that you might need. Finally, you've got those assets that you definitely don't need. If you've got more than enough, and you might have something that you think, well, I'm never going to touch that in my lifetime, you could then think about passing that on. So what are the benefits of passing on your wealth to your family? Well, I've touched on a bit of this over the last few minutes, but you'll have the opportunity to help your family decide how to use your assets. If they're new to investing, if they're new to managing money, you can help give them that education. They can learn from the decisions that you've made, and you can pass that on to them in the way that we've just been discussing. So showing them around how to make their own investment decisions, showing them tools to use, helping steady their nerves potentially when the markets are going up and down a little bit. You can see them enjoy the gifts that you've given them. So if that's going on holiday, you can see their smiles. They might take you along with them. If that's improving their home or potentially being able to afford a better home, then you can see them enjoy that as well. And finally, but also quite importantly, it may also help you reduce any inheritance tax bill that you may otherwise incur. And on that note, I'm just going to pass over to my colleague Adam, who'll be able to run you through those inheritance tax considerations.
Thank you, Rohan. Excellent there. So, as I said, my role here is I'm one of our financial planners here at Hargreaves Lansdown. And essentially what I'd like to do is develop some of the good work that Rohan has done in terms of understanding the relationship with money and obviously the considerations where you are trying to help and support your family with particular sort of gifts that you may plan to make. But let's now think about inheritance tax. What drives this? But also let's consider the basics. This really is a taxation that is paid by your beneficiaries on assets that they stand to inherit from your estate. And the term net estate is essentially everything that you decide to pass on death, typically excluding pensions, but we'll come back to that in a moment, allowing for the deduction of applicable exemptions that can be passed on tax-free. Typically speaking, the headline rate of inheritance tax is 40%, but there are scenarios where that can be less. There are a number of exemptions and allowances available to you to consider. That can mean that the tax paid could be potentially lower in the future, but of course, the unknown position here is ultimately what will tax rules look like in the future, and particularly with longevity. If you're trying to plan for the here and now, that's fine, but in 10, 20, 30 years, what will the tax rules be? So it's really important to try and think about the decisions that you're making and allowing for a number of variables to factor in. Next slide. Sorry, the slides seem to be frozen a second.
Slide. There you go.
Thank you, Rohan. So I've just asked you to fit through the presentation, if that's okay. It's stuck here on my end, so that's fine. So so moving on to, as I said, one of the main exemptions to consider is the nil rate band. So the nil rate band it's our jargon really, but essentially it's an amount that you can pass on when you die. And it's tax-free to the beneficiaries. The nil rate band is £325,000 per person. That can be reduced by what's known as failed lifetime transfers. So that's essentially if you give away some capital and you're unfortunate not to live 7 years beyond the date of that gift, that will come back into the estate and will be utilised against the nil rate band initially with other assets that you have that sit on top. There are some exemptions to be mindful of as well, and these include unconditional gifts to UK domiciled spouses or civil partners. There are allowable gifts to charity and political parties where they're fully exempt, and I think that's an important point just to touch on briefly, because there'll be some of you here that naturally will have accrued, significant levels of wealth, where inheritance tax obviously is an issue, where your estate is above that threshold amount. Of course, you may want your children, your niece, your nephew, your family to inherit the assets, but sometimes thinking about gifts to charity can be a way that actually can reduce the amount of tax that you pay, and obviously you can nominate causes that are close to your heart, so to speak. Obviously, in your lifetime, there are some other gifts to be aware of or exemptions. So you do have these small gifts of up to £250 to any number of individuals. The annual exemption is an allowance that you can gift that is immediately outside of the estate, i.e. you don't have to live 7 years. That typical amount is £3,000 per person. If you haven't used that in the previous tax year, you can actually go back and carry that forward for one tax year as well. So if you take an example of a couple, never done any gifting, what they could do as a couple between them is essentially gift £12,000, i.e. 6,000 combined in this tax year and 6,000 carried over the previous tax year as well. We'll touch on normal income exemption in more detail later, but essentially you can give away surplus income, and that's an exempt amount in terms of any gifts that you're looking to make. And there are set amounts for weddings depending on the relationship to the individuals married. Now, something important to touch on as well is the nil rate band is a single allowance per person. So it depends on your circumstances, whether you are single, widowed, or married. But if you take the scenario of a couple, married in a civil partnership, if on first death, i.e. the first of you to pass away, you decide to leave assets to one another, and then on second death down to your beneficiaries, there's no inheritance tax typically to pay on the first death, as I said, for UK domiciled spouses. So you normally delay and defer the inheritance tax to the second death scenario. However, the nil rate band by the first spouse that passed away has not been used. So therefore, your legal personal representatives should be able to reclaim 200% of the nil rate band, i.e. you double that up to 650,000 if you look at the current nil rate band levels. Next slide, please, Rohan. So also something to be mindful of as well, on top of the nil rate band, is another exemption, which is called the residence nil rate band. Now, that was introduced a few years ago, back in April 2017. And essentially, this was an additional allowance that was applicable to your main residence. However, there were some conditions around that, because in order for that to be claimed, when passing on your assets on death to beneficiaries, they must be what's called linear descendants, i.e. children, grandchildren, great-grandchildren, and so forth. That does include step or fostered or adopted children. Now, again, it's a similar concept on first death and second death to the nil rate band. So if we take the scenario of a couple and we model that through again of first death to surviving spouse, second death, let's say, to children, it means in theory, if the main residence has a value of £350,000 and more, they should be able to claim potentially up to £1 million using the combined nil rate bands and residence nil rate bands in that scenario. So therefore, there is some considerable exemptions there to pass on. This can be a bit complex in some scenarios, because on death, if the estate is particularly sizable, i.e. 2 million and above, for every £2 of excess, there is a tapering of the residence nil rate band where one loses £1. So again, if we model that scenario of a couple, let's say on second death, the net estate is 2.7 million and above, it completely wipes out the effect of the residence nil rate band. And in some respects, it's like a effective tax rate of 60% between 2 million and 2.7 million, with the typical 40% IHT rate applied, with the loss of the residence nil rate band. So obviously you have to be mindful of the planning opportunities that exist in order to try and maximize those exemptions, again, on a case-by-case basis. Next slide, please, Rohan. So before we start thinking about options and solutions and some of the decisions that you can make, I think it's important to think about some of the main exemptions and reliefs one would use when you're trying to plan. If you start with potentially exempt transfers, or PET for short, that simply refers to lifetime transfers or gifts that you plan to make. That is not within your annual exemptions or gifts from surplus income. This is effectively capital that you are wanting to gift away in your lifetime. The reason it's potentially exempt is you still must survive 7 years and beyond for that gift to then become exempt, i.e. it's potentially exempt, with a condition of you live in 7 years and beyond. There is some complexity around this with what's called taper relief, but as I say, in the essence of time, we're not going to work through some examples there. But essentially, if you're gifting away significant sums, i.e. more than your nil rate band of £325,000, that's where you will consider taper relief and its effects. If you're gifting less than that, it's typically not a planning consideration as such. Normal income exemption, I will come back to that in a little bit more detail and depth in terms of gifts out of income. But essentially, it's gifting away income that is surplus to you. That's effectively not been treated as capital. So therefore, you're utilising your income in a way and spending it in a way that you see fit, including gifting it away to potential beneficiaries. Business relief, whilst it's an exemption and relief, it can also be one of the main solutions as well to potentially reduce inheritance tax. But essentially, it's owning qualifying assets that are exempt from inheritance tax. So that could be some of you listening in today. You could be business owners. The company could be a trading company, and the company needs to continue when you pass on. And that, in some scenarios, it could be 100% free of inheritance tax to allow the company to continue. There are, for our sophisticated investors, options to invest into untraded companies. Could be some shares on the AIM market, for example, or some assets that qualify for that. But again, that tends to suit a narrower pool of individuals based on their knowledge, their experience, their capacity to accept loss. But of course, it's something that could be considered for the right client. And again, I'll come back to this in a bit more detail on a later slide, but actually not to overlook or ignore pensions. So pensions can be viewed, again, with the right set of circumstances based on your position as a way to potentially pass on additional wealth outside of your estate as well. Next slide, please, Rohan. So in trying to think how they can help you, and again, looking at some of these exemptions as well, let's actually strip this back a bit more to basics. Firstly, you need to consider actually, do you have an inheritance tax liability once you've actually looked at nil rate bands and potentially residence nil rate bands based on your situation? If you do not have a liability, actually think about, could you have one in the future? If you're building up surplus income and capital and you might be under now, what if you live a long time, and what if you're able to accrue more wealth or more assets? It could be an issue to be mindful of later on in life. But ultimately, establishing what the liability is and monitoring and reviewing that is important. And obviously, if you do have one, as Rohan alluded to earlier on, in that triangle, there'll be income streams or there'll be capital assets that you will absolutely need now and in the future. There'll be some income and assets, for example, you might need, and that could be for change of circumstances. It could be the first death position. It could be the impact of paying for long-term care. It could be supporting out loved ones at point of need in terms of financial emergencies. There could be other emergencies that you haven't planned for, or a change of your income or capital requirements. So ultimately, planning is about being adaptable and modeling a number of scenarios. But ultimately, if you identify in going through that exercise, there is assets and income that, quite frankly, you're unlikely to need, then you might consider passing that wealth on now, because ultimately the benefits, as Rohan talked about, is, what can it do now for your family? Can it reduce the overall liability? So again, it's identifying and what we call earmarking of assets. And of course, would you be able to make use of some of those exemptions, such as making those lifetime transfers, i.e. capital that you may never need? Or if you're fortunate enough that you have quite substantial income, it could be that you're retired and you have, the certainty of secure income from a final salary pension, or you could have converted a pension to secure an income through an annuity, for example. Do you have excess income that you can afford to gift away? So again, this is all on a case-by-case basis, and your circumstances are completely unique. But ultimately, there are things that you can do yourself and some things that you can think about to effectively support your family and naturally reduce the potential impact of inheritance tax. Next slide, please, Rohan. Fine. So this slide, don't be daunted by this because I appreciate this is a bit of a flow chart here. And when we say inheritance tax planning, the options, this isn't an exhaustive list of all the options that are available to consider. Before I take you through this flow chart, I think it's important to explain what a financial planner will do in a consultation to actually try to get you to think about and navigate what options are appropriate. And I will, in the essence of time, have to simplify this somewhat because some of these options actually could require a bit more time spent and a bit more detail that we go into. But obviously, we don't have the time available today to explore that in the depth and the detail that would be required. However, if you start to think about, okay, let's actually break this down. There's generally a range of options that could include 5 possible strategies. And actually, let's look at the most commonly overlooked strategy. Spend more of your money on you. So actually enhance your lifestyle, increase your expenditure. And I know that's easier said than done for some, particularly if you've accrued substantial sums of capital or your lifestyle couldn't be comfortably met with those assets. But of course, if you've worked hard to accrue and build up your wealth and your assets and you're sitting in that territories of inheritance tax, why not actually reduce your estate simply through increasing and enhancing your lifestyle and spending more of your income, more of your capital? The second option actually we've alluded to, which is actually thinking about giving away capital that you don't need or you're likely to never need in the future, which is effectively those lifetime transfers or potentially exempt transfers, or essentially it's gifts now that your family or beneficiaries can enjoy. Actually, of those first 2 options, those are decisions actually you can make of your own accord. You don't necessarily need someone like myself or Rohan actually to provide specific advice around your strategy in terms of spending more or potentially gifting some capital away. There'll be some clients that will require that support in terms of a broader financial plan. But as you know, at Hargreaves Lansdown, we try to give you the tools and the information so you can make sense of that. And if capable, if you have the inclination to do so and the confidence, ultimately, we want you to make those informed choices. So these are strategies that exist to you. The next 3 strategies tend to be taken through professional advisors. So it's not to discount, the option in terms of you being able to make your own choices. Actually, a lot of these options do require regulated advice where an advisor takes responsibility for the recommendations because these solutions can be considered to be complex. And what we're referring to here is essentially we'll start with the main one, which is trusts. Now, that's a completely different topic in itself. A trust really is the same consideration as when you are thinking about gifting away capital. But for whatever reason, you're just not quite comfortable giving that capital away to family now. That could be for a number of reasons. That could be distrust of your heirs. It could be, it could be more distrust of your heirs' partners. We know divorce rates and where things sit today. So sometimes giving away substantial sums now, you could be concerned about the implications of doing that as well. So fundamentally, our clients that consider trusts effectively want to remove capital from their estate, but they want a degree of control and protection of assets, which is why trusts are generally considered. Now, if we actually look at the flow chart, because this flow chart tries to navigate some of the options, and if we start with that question, is income or capital available, we'll go straight into capital because this is where trusts are generally set up. And then the first consideration is, okay, look, if you can identify some capital that you're happy to part with, your first question is, do you need income if you deprive yourself of capital? Yes or no? And then once you've answered that yes or no, the second consideration is, would you need any access to the capital? Again, yes or no. So if we start on the left of that channel from do you need income? No. Do you need access? No. Then an outright gift just into a trust that you set up where you have no access, no access to income or capital is something that you'll be considered. And actually, if you go back to our triangle, that will be assets that will fit in the don't need camp. So that's capital. Effectively, you're doing the same thing as a lifetime transfer, but ultimately the trust now becomes the owner of those assets, and ultimately you remove the capital from the estate. The same principle applies in terms of 7 years. So ultimately, after 7 years, the capital is outside of the estate, but from day one, any potential growth that you receive is again outside of the estate. If actually you didn't need the income, but you might need some access to capital, some clients might look to loan capital to a trust under what's called a loan trust. And there's a more complex arrangement, which is called a revert to settler trust, which will allow scenarios periodically for return of capital in where it's required based on a number of different factors. Now, if we go back up to, do you need income? Yes. Do you need access? Yes. Again, it's very similar to the loan trust and revert to settler trust, because it's about giving flexibility to have access to either income or capital, depending on what your needs are. However, if you do need an income, but you don't need the capital, there is a trust that is structured, which is called a discounted gift trust. Now, we're not here to obviously go through what each trust does, how it all works, what the tax position is, because these are all different variables that will be considered on a case-by-case basis. But ultimately, when you are reading up and you're learning about this trust, and as I said, what I will make you aware of is there is our guide to inheritance tax. You can download that from the Hargreaves Lansdown website. We put some information in there about the different types of trust to give you some high-level context around that as well. And hopefully that should frame this conversation as well. However, what we would say is if you are considering that third option of transferring your assets into a trust for control and protection, it is absolutely vital to have a conversation with someone like myself or Rohan or a professional advisor, so you can really understand the type of trust, the considerations that need to be looked at, and ultimately whether it is in your best interest to consider a strategy like this. It could be this is a strategy alongside that first option of spending some more on yourself and giving some money away in lifetime. So it's not a silver bullet, so to speak. It's not a one size fits all, just pick one. It could be a combination. The fourth option, if we go back up to the top of that flowchart, which is income or capital available? So let's talk about income. So if you actually want to keep control of your assets and control of your capital, so you're not happy giving that away or giving that into trust where you remove the capital from the estate, your capital assets could actually potentially generate income. So for those of you that invest money here, you may very well be au fait with if you invest into the stock market, shares can create potential dividends based on the types of companies that you own. If you invest into fixed interest or what's called corporate bond gilt markets, they could pay interest. If you hold cash, cash can derive interest as well. So it's not just the obvious streams of income that you have to factor in terms of employment, retirement income, pension income. It's actually what your capital is doing to create and derive income. If actually you are meeting your lifestyle with a surplus income, some clients, if they actually feel that they might need their capital in the future, so they can't quite part with it, they actually might choose to insure the liability. So the fourth option to think about is whole of life assurance. It's essentially a life assurance policy whereby you structure it in what's called a whole of life term. So basically what that means is as long as you continue to pay the premiums until you pass away, there can be an amount that you can insure for that can be, again, held in trust, paid outside of the estate, that the beneficiaries can effectively use to contribute towards some or even all of the potential liability in the future. So therefore it allows the rest of your assets to remain intact. So that, but obviously these are insurance policies, so it's based on age, health, longevity, and they're all medically underwritten as well. But it can, for the right set of circumstances, it can be very valuable to consider this again, maybe in isolation or in combination with those other four. The fifth option, I did briefly touch on this earlier on, which is business relief. So I mentioned there are business relief strategies. It's not on this flow chart here because it's not really giving up income or capital. It's just investing your money in a different way into assets that will qualify for an exemption after 2 years. But as I said, in order for you to consider something like that, there must be a degree of sophistication in truly understanding the potential risks that you would be taking on. But obviously, on a case-by-case basis, that can be considered. And I appreciate this might be tongue-in-cheek. If you go to the top left, is income or capital available? Well, no. And we say get somebody else to pay with an exclamation mark at the end of that. What we're really saying is actually, look, who's going to benefit here? Is it you? No, actually, it's your family. So who actually is inheritance tax or taxation on? Yes, it's a tax on the assets that you previously had, but it's a taxation on those assets on who stands to inherit, i.e. your family. So there could be scenarios where there could be some planning opportunities for your family to support and be involved in, in the overall process. But as I said, it's not a one size fits or one strategy fits all. Actually, inheritance tax, it's trying to make sense of all these different options and trying to build a plan that, and actually, if you think about this from a planning position, the primary concern is your own longevity, your own lifestyle, and all the unknown variables that life will throw at you. It's very much a secondary consideration to actually plan for inheritance tax once the right steps have been taken, quite clearly to plan for your own lifetime first. So, as I said, that hopefully gives you just a whistle-stop tour of some of the options that are available to you. What I'd like to do now is obviously just a wrap up and move on to the final few slides. So if you don't mind, Rohan, to next slide. So yeah, I said I would come back to something on that list of 4 exemptions earlier on, which was pensions. Now I think this is more impactful under the age of 75 than it is over the age of 75, albeit I won't discount it entirely. So we find actually, when our clients are looking to plan for inheritance tax, because it's important to establish your needs and objectives clearly first, we find from a timeline perspective, most clients will tend to make a lot of the strategic decisions actually in or at retirement. Because if you think about this logically, if you've already established yourself, you're no longer in the workplace and you're not reliant on ongoing earnings to support your lifestyle, you're now being clear about your own sort of future requirements on the assets that you've actually saved to fund yourself in retirement. So what will happen is when you start to structure a retirement plan and you think about income, capital requirements, capital expenditures and whatnot, you may be fortunate enough that you've built up different assets across property, cash, it could be other investments, or including other pension pots as well. Pension death benefits mean that if you pass away under the age of 75, it is typically paid tax-free to your beneficiaries, and it's effectively in the vast majority of scenarios outside of the estate. The reason I'm saying vast majority is there can sometimes be scenarios where individuals in ill health transfer a pension, deemed a transfer of value by HMRC if you die within 2 years, and potentially taxed for inheritance tax, but typically speaking outside of the estate. So actually it makes the planning a little bit more interesting, because if you've got a situation where there's cash, investments and pension assets and then needed to use in part to generate income in retirement, with an inheritance tax liability that sits there, it might be more efficient to actually use the non-pension capital first in terms of liquidation and leave the pension assets alone, particularly with some of the recent changes to the pensions lifetime allowance. But again, that's not a session for that today. Over the age of 75, they still are typically outside of the estate. So in terms of passing on wealth outside of the estate, they can be pretty valuable in that respect. However, it is taxable at the beneficiary's marginal rate of tax. So therefore, if the pension pot was substantial and the beneficiary in that particular tax year wanted to liquidate the funds, they could in theory pay tax at 40% or 45% if you're looking at English tax rates for a higher rate and additional rate taxpayer. So it could in some respects be tax neutral. Obviously, if they don't make the withdrawals and they take it at basic rate, it could be more tax efficient as well. So it depends on the tax position of the beneficiaries when you look at the position, over the age of 75. So hopefully, again, that just throws another strategy there for you to think about when you're at retirement and thinking about whether you access your pensions or you leave your pensions alone. Next slide, please, Rohan. So very briefly, just again, link this all together. When we talk about adding value for advice and a long-term strategy, any decent, well-rounded, qualified financial advisor will be looking to understand you and what your strategy is. We'll be looking to understand what your objectives are, what your immediate goals are versus long-term goals, and ultimately we're trying to make sense of what your priorities are. Then you'll look at all the the income requirements. Will that change? What's the position if it's a couple in terms of second death, first death, and whatnot? You'll look at capital requirements now and in the future. You'll look at longevity. You'll look at health. You'll look at your views on estate and inheritance tax planning, and try to build together a framework where you can move forwards with confidence. And in something in an area like this where it can be complex, ultimately there can be a lot of value added through financial advice in this scenario. Next slide, please, Rohan. So just to briefly allude to a bit more ongoing support. So for those of you that are less so fait with the Hargreaves Lansdown website, you can go to the website, which is www.hl.co.uk. There is a wealth of information on there. I mentioned earlier on, downloading where you can our guide to inheritance tax. If you can't source that, the telephone number at the bottom is actually our advisory help desk. You're more than welcome to get in touch and request guides, and they can be emailed and sent to you or posted to you if on request. We do also, on our advice side of the website, have a lot of financial advice insights, including inheritance tax articles as well, which are a useful read. For those of you that have smartphones and tablets, the HL app also is accessible as well. And any additional questions, if you're not looking to give us a call, you can funnel them through to advice@hl.co.uk. So what have we covered today? So Rohan has kindly gone through your relationship with money. We've tried to talk to you about the basics of inheritance tax and understanding inheritance tax. We've gone into some detail about the options available to you, albeit there's much more to explore on that topic, I should add. And obviously the benefits of having financial advice. So that's ultimately what we've covered today. So I'm just going to leave our important action notes slide up. If you just take the time to read that, we'd be most grateful. And just remember what I should say, this is just guidance and it's not personal advice as well. But again, please do take the time to read through the slide. Okay, so thank you ever so much for listening today. I'm going to hand back over to my colleague Rohan just to wrap things up before we move on to the Q&A.
Yeah, thanks a lot for taking time to listen to the webinar today. We'll just take some Q&A now. But if there is anything that you want to contact us about directly, you've got the contact details on your screens now. Thank you.
Thank you.